We're going to continue on discussing how we account for treasury stock. Now, treasury stock's the name given to a corporation's own stock that it has reacquired. Over 2/3 of all publicly traded companies report treasury stock on their balance sheet. The reasons why a company would want to buy back its own stock are to boost underpriced stock. So when a company's management feels the market price of its stock is too low, then it may attempt to support the price by decreasing the supply of stock in the marketplace. An announcement by Johnson & Johnson that it planned to buy up to $5 billion of its outstanding shares triggered a public buying spree that pushed the stock price up more than 3%. Now, to distribute surplus cash without paying dividends, so while dividends are usually a good thing, investors do pay personal income taxes on them. Another way for a firm to distribute surplus cash to shareholders without giving them taxable dividend income is to use the excess cash to repurchase its own stock. So under a stock repurchase, only shareholders selling back their stock to the company at a profit incur taxable income. To boost earnings per share is another reason that treasury stock is purchased. Stock repurchases reduce the number of shares outstanding, therefore it increases earnings per share. However, with less cash in the company, it's more difficult for companies to maintain the same level of earnings following a share repurchase. And then lastly, treasury stock satisfies employee stock ownership plans. Another motivation for stock repurchases is to acquire shares used in employee stock award and stock option compensation programs. Now, remember, oftentimes it's easy to confuse the purchase of treasury stock with investments in another company. An equity investment in the purchase of stock in another corporation is an equity investment, and we record it as an increase in assets. But treasury stock is the repurchase of the corporation's own stock, and we record that in the stockholders' equity section as a reduction. It's not an asset. A company cannot invest in itself. Over 2/3 of all publicly traded companies report treasury stock on their balance sheets. This slide provides a summary of cash dividends and stock repurchases for the 1,000 largest companies in the United States. Let's now assume that Canadian Falcon repurchases 100 shares of its own 1 cent par value common stock at $30 per share. We record this transaction as shown here. Just as issuing shares increases stockholders' equity, buying those shares back decreases stockholders' equity. Rather than reducing the stock accounts directly, though, we record treasury stock as a negative or contra account. Recall that stockholders' equity accounts normally have credit balances, so treasury stock is included in the stockholders' equity section of the balance sheet with an opposite or debit balance. When a corporation repurchases its own stock, it increases or debits treasury stock while it decreases or credits cash. Note that the stock's par value has no effect on the entry to record treasury stock. We record treasury stock at its cost, which is $30 per share in this example. The debit to treasury stock reduces the stockholders' equity. This slide shows the stockholders' equity section of the balance sheet before and after the repurchase of treasury stock. So as you see here, treasury stock is reported as a contra equity, or a negative amount, since treasury stock reduces total stockholders' equity. Now let's assume that Canadian Falcon reissues the 100 shares of treasury stock for $35. Remember that these shares originally were purchased for $30 per share, so the $35 reissue price represents a $5 per share increase in additional paid-in capital. It's not recorded as a $5 per share gain in the income statement, as we would for the sale of an investment in another company. Since this company is just reissuing its own stock, we record this transaction shown on this slide, a debit to cash for the full amount, 100 shares times 35, a credit to treasury stock for the amount we initially repurchased those shares for, which is 30, and then a credit to additional paid-in capital, that which we're reissuing this treasury stock for, that was above the cost of what we purchased it for. This slide presents the stockholders' equity section of the balance sheet before and immediately after the sale of treasury stock. So as you see, before we have the contra account treasury stock. After, it's gone, and in addition, since we reissued that treasury stock for more, we have increased our paid-in capital for $500. Now let's assume Canadian Falcon later purchases and reissues the 100 shares of treasury stock for only $25 rather than $35. This is how we record the entry. By purchasing 100 shares of its own stock for $30 per share and then reissuing them for only $25 rather than $35 per share, Canadian Falcon experienced a decrease in additional paid-in capital. This is reflected in the entry as a debit to additional paid-in capital account. It's not recorded as a $5 per share loss on the income statement as we would if it was an investment in another company, because in this case the company is just reissuing its own stock. A key point to remember: we include treasury stock in the stockholders' equity section of the balance sheet as a reduction in stockholders' equity. When we reissue treasury stock, we report the difference between its cost and the cash received as an increase or decrease in additional paid-in capital. Let's look at exercise 10.6. Finishing Touches has two classes of stock authorized: 8% $10 par preferred and $1 par value common. The following transactions affect stockholders' equity during 2018, its first year of operations. There are 4 transactions. The first, January 2nd, issues 100,000 shares of common stock for $35 per share. On February 6th, issues 3,000 shares of 8% preferred stock for $11 per share. September 10th, repurchases 11,000 shares of its own common stock for $40 per share. And December 15th, reissues 5,500 shares of treasury stock at $45 per share. So we need to record each of these transactions. The first one being issuing 100,000 shares of common stock for $35 per share. Remember, the par value is $1 per share. So we will take and debit cash 100,000 shares at $35 per share. We will record in common stock as a credit just the par value. So we take 100,000 shares times $1 per share. We record in common stock the par value of the stock, $100,000. Then we will credit additional paid-in capital for the amount above and beyond par value, or the $3,400,000. That we will record as issuing common stock above par. The next one is on February 6, issues 3,000 shares of 8% preferred stock for $11 per share. Note, preferred stock has a par value of $10 per share. As you see, 3,000 shares times $11 will be a debit to cash of $33,000. We will show in preferred stock only the par value, 3,000 shares times $10 per share. We will record in additional paid-in capital the difference above the par value, which was $1. So 3,000 shares times $1 will go to additional paid-in capital for $3,000. And we record it as issue preferred stock above par. On September 10th, we repurchased 11,000 shares of its own common stock for $40 per share. Remember, when we reissue common stock, or purchase it, I should say, we do not care about the par value. We just debit treasury stock for the full amount, and we credit cash for the full amount to show we purchased treasury stock. Then on December 15th, we reissued 5,500 shares of treasury stock at $45 per share. What's important to note here is what we initially purchased that treasury stock for. It was $40 a share. So when we report this transaction or record this transaction, we're going to debit 5,500 shares at $45 for a debit of cash of $247,500. We will credit our treasury stock for what we purchased it for, $40 a share. So we are selling it or reissuing 5,500 shares at $40 a share will be our credit to treasury stock, and then that amount above and beyond, or possibly that amount below the amount that we had originally purchased it for, will be put into additional paid-in capital. In this scenario, it was an additional $5 that we reissued it for, so we will credit our paid-in capital, the amount of shares, 5,500 times $5 per share. Treasury stock. A has a normal credit balance. B decreases stockholders' equity. C is recorded as an investment, or D increases stockholders' equity. Remember, when we invest in other companies, it's an asset. When we purchase our own stock, we reduce our stockholders' equity account. It is a contra account. Next, we're going to talk about earned capital, and we're going to describe retained earnings and learn how to record cash dividends. So retained earnings represent the earnings that are retained in the corporation. The earnings that haven't been paid out as dividends to stockholders. So, in other words, the balance in retained earnings equals all net income less all dividends since the company began its operations. Now, in a company's early years, the balance in retained earnings tends to be really small, and total paid-in capital, the money invested into the corporation, tends to be a pretty large number. But as the years go by, the earnings retained in the business continue to grow, and for many profitable companies, can exceed the total amount originally invested in the corporation. Unfortunately, for some companies, expenses sometimes are more than revenues, so a net loss rather than a net income can be recorded. Just as net income increases retained earnings, well, a net loss can decrease retained earnings. Retained earnings has a normal credit balance, consistent with all other stockholders' equity accounts. But if losses exceed income since the company began, then the retained earnings would have a debit balance. Now, a debit balance in a retained earnings is called an accumulated deficit. Not what we want to see. We subtract an accumulated deficit from total paid-in capital in the balance sheet to arrive at total stockholders' equity. Many companies in the startup phase or when experiencing financial difficulties will report an accumulated deficit. This slide shows how net income and dividends impact the balance in retained earnings over a 4-year period. In year 1, the first year of operations, the company reports a net loss of $1,000. It's quite common for companies not to be profitable in the startup phase of a business. Now, the net loss results in a balance of $1,000 in retained earnings. Minus $1,000, I should say. In year 2, the company reports net income of $3,000. This means that by the end of year 2, all net income minus all dividends, which are 0, results in a cumulative balance of $2,000. In year 3, a difference between net income and dividends is $3,000, which is the $4,000 they earned minus the $1,000 in dividends they paid out. And this amount adds to the cumulative balance of retained earnings to give us $5,000. Then in year 4, the difference between net income and dividends is $7,000, once again adding to the cumulative balance of retained earnings. This process of adding net income and subtracting dividends each year to calculate the cumulative balance of retained earnings continues over the life of the company. Another one of these common mistakes, a lot of people think incorrectly that retained earnings represents a cash balance set aside by the company. The size of retained earnings can differ greatly from the balance in the cash account. American Eagle reported $1.5 billion in retained earnings, but only had $410 million in cash. Now think about it. Oftentimes those retained earnings are used to purchase assets, to pay off debt, and so it is very common that the retained earnings will not at all represent the cash balance. Dividends are distributions by a corporation to its stockholders. Investors pay careful attention to cash dividends. A change in the quarterly or annual cash dividend paid by a company can provide useful information about its future prospects. So, for instance, an increase in dividends often is perceived as good news. Companies tend to increase dividends when the company is doing well and future prospects are promising. The day the board of directors declares a cash dividend to be paid is known as the declaration date. The declaration of a cash dividend creates a legal obligation binding for the company, declaring the dividend. On that date, we increase dividends, a temporary account that we end up closing out into retained earnings at the end of each period, and increase a liability account, dividends payable. The board of directors also indicates a specific date on which the company will determine the registered owners of stock and therefore those who get to receive the dividend, which we call the record date. Then, investors who own stock on the date of record are entitled to receive the dividend. The date of the actual cash distribution is the payment date. So it's important to remember we've got 3 dates to remember: the declaration date, the record date, and the payment date. So here we see the disclosure of American Eagle's dividend policy. Note that it's the board of directors that declare the cash dividends to be paid. So as you see, on December 4th, the board of directors of American Eagle Outfitters declared a dividend of 11 cents per share, payable on December 28th to shareholders on record as of December 19th. The payment of future dividends is at the discretion of our board and is based on future earnings, cash flow, financial conditions, capital requirements, change in U.S. taxation, and other relevant factors. It's anticipated that any future dividends paid will be declared on a quarterly basis. So the declaration date was December 4th. The record date is December 19th, and the payment date is December 28th. Dividends are paid only on shares outstanding. They are not paid on treasury shares. So to illustrate, assume that on March 15th, Canadian Falcon declares a 25-cent per share dividend on its 2,000 outstanding shares, 1,000 shares of common stock, and 1,000 shares of preferred stock. The dividends account is a temporary stockholders' equity account that gets closed out into retained earnings at the end of the period. Assume the dividend declared by Canadian Falcon is paid on April 15th. The payment is shown in the second entry. So as you see in the first entry, the declaration date is when we record the dividends, 2,000 shares at 25 cents a share, a debit of 500, dividends payable, a liability account, which is a permanent account, of 500. The payment date, we debit the dividends payable and we credit our cash. Another key point, the declaration of cash dividends decreases our retained earnings because dividends will be reduced from retained earnings, and it increases a liability account, dividends payable. Then the payment of cash dividends decreases our liability, dividends payable, and decreases cash. Ultimately, the effect is a reduction to both retained earnings and to cash. Let's take a look at exercise 10.5. Italian Stallion has the following transactions during the year related to stockholders' equity. On February 1st, we issued 6,000 shares of no par common stock at $16 per share. On May 15th, we issued 700 shares of $10 par value preferred stock for $13 per share. On October 1st, we declared a cash dividend of $1.25 per share to all stockholders on record on October 15th. On October 15th, it's the date of record, and then on October 31st, we pay the dividends. Let's record these transactions. The first one being, on February 1st, we issue 6,000 shares of no par common stock for $16 per share. Now, when we have no par common stock, we don't have to worry about an additional paid-in capital. So we debit our cash, 6,000 times 16 bucks, 96,000. We credit common stock, 6,000 times $16. On May 15th, we issued 700 shares of $10 par value preferred for $13 a share. So in this scenario, we will have an additional paid-in capital. We debit our cash, 700 times $13 for $9,100. We credit our preferred stock, 700 shares at $10 a share, and we credit our additional paid-in capital, that amount above and beyond the par value. So the preferred stock will be 7,000. The additional paid-in capital will be the 700 shares times $3 a share, or $2,100. Next, on October 1st, we declare a cash dividend of $1.25 per share to all stockholders of records. So we have 6,700 shares outstanding. 6,700 shares times $1.25 a share, $8,375 would be a debit to dividends, and we credit dividends payable for $8,375. Next, the record date. Date of record, October 15th. We don't do a thing on that day. There is nothing we need to do on the date of record. No entry, as you see right here. Then, next, we pay the dividends. As you see, the payment of the dividend, we debit the liability dividends payable for $83.75, which reduces then our liability, and we credit cash for the same amount, the pay cash dividends. Here's one more question for you. On which date would a company record a debit to dividends and a credit to dividends payable? Date of declaration, date of record, date of payment, settlement date. Date of declaration is when we record the dividends and the payable. It becomes binding as of that date.